Hi everyone, welcome to Chapter 12. In Chapter 12, we're talking about issuance of stock, cash dividends, stock splits, everything that really deals with corporations and how they could raise money via equity. So we talked about some of this stuff briefly before. Again, stock or common stock is an equity account that goes up with a credit. But now we're going to get into the specifics. So to demonstrate this in exercise 12.3, they talk about this company on January 22nd, a marble contractor issuing for cash 180,000 shares of $20 par common stock at 23. So what that means is they're essentially issuing means selling to investors pieces of the business, and they're going to sell for $23. So that's what this 23 is. If you're wondering what the 20 is a par value. Every corporation, when they incorporate within a state like New Jersey, Delaware, Pennsylvania, and when they do that, the state law says they have to incorporate and put a value on the stock. It's an arbitrary number. It's a made-up number. It happens before they even start any business, before they even conduct any business. So that $20 was a number that they assigned as a value to their common stock before they started. When they actually issued it, it was worth 23, so they got $3 more for each share. So that's kind of, when you look at that in the problem, if you see par value, that's the number that it was assigned, an arbitrary or made up number when they incorporated, but really what they sold it for was 23. They also issued for cash 25,000 shares of preferred stock, par value 7, they sold it for 9. So again, they assigned a value of 7 for the preferred stock, but they sold it for more. If you're wondering what preferred stock is when you sell a stock that is different than your common stock in some form or way. Typically what it typically gives, a preferred stock typically gives a dividend every year. So preferred means preference, so it's slightly better than a common stock. So that's what the preferred stock is. Common stock is just regular stock. Preferred stock is something up and above it. They want us to journalize the entries for January 22nd and February 27th. And then they also want to know what the total amount invested, or what we call paid in capital, in the stock. Paid in capital is just a name for people buying into the company. So that would involve everything. All right. So again, to show you these transactions, on January 22nd, when they issued the common stock, what the cash would have increased by would have been 180,000 shares times the $23 per share. That's what they sold them for, or issued them for. So they got in 4,140,000. That would be increasing their assets, specifically cash. On the other side of the accounting equation, or the other side of the journal entry, I should say, common stock would go up by 180,000 times the par value. So this is what's unique to this chapter. Notice we're using 20, that's the par value, for 3,600,000. That difference, the amount up and above the par value, which is really 23, what they sold it for, minus the 20, which is really $3 per share, the difference between these two, times the 180,000, goes into a very long account called paid in capital excess of par common stock. It's also an equity account. It's very similar to common stock, but it's the amount that's up and above, so it's called paid in capital excess of par hyphen common stock. That would be 540,000. Notice that the 3.6 million plus the 540,000 equals that, because again, our debits and credits always have to equal. So that's the first transaction. The second transaction relates to the preferred stock. Again, they sold it for $9 per share. They issued 25,000 shares. So that's where that cash went up for. Notice the preferred stock went up by the $7 per share, that's the par value. So again, you always use the par value times the 25,000 shares to get that number. And then the excess, the difference, the up and above, the 9 minus 7, which is $2, times the 25,000, which is 50 grand, goes to paid in capital. So again, really the only difference between January 22nd and 27th is this was a common stock, so we use common stock. This was a preferred stock. Both are equity accounts, both go up with credits, so they're similar in that way. Obviously, cash went up in both of them, and we use paid in capital in both. So again, the only real major difference is one is a common stock, one is a preferred stock. Finally, for Part B, the amount that would have been invested would be the summation of, you could either add up this, 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 and this, all 4 credits, or just simply add the cash and both of them together, and you'll get $4,365,000. That represents the money that was invested in the business that the company now has, that hopefully they're going to expand their business with. All right, hopefully this helps, and I'll talk to you soon. Take care.